welcome back everyone, Michael here with Offshore Citizen. I'm going to be doing a variety of different videos where I'm going to try doing a fair bit more deep dive. I did a lot of these in the past, talking about specific tax concepts, specific tax strategies. It is something that other people don't seem to do a particularly great job of, and so there's sort of an opportunity to kind of share some insights that otherwise wouldn't be out there. And so we're going to talk today about one of those with respect to Canada. And this is if you're interested in relocating to Canada, sort of what I would call pre-immigration tax planning. So it's pretty niche for people who are not in that situation. So that's going to be most of our audience. It might be interesting for you just from the standpoint of like, hey, listen, here's how some of the international tax rules work, and here's how this would come into play. And it might make you think of stuff that applies in your country or where you're going, et cetera. However, that being said, the rules are specific to every country, lots of different nuances. It's something that we have to spend tons and tons of time staying on top of, et cetera. And there are a ton of anti-avoidance rules. And so essentially they're like ways that the government is not making it so easy and straightforward for you to take advantage of. So in that sense, you want to be pretty careful about how these things go. However, there are some really interesting points for Canada specifically. And so I'm going to talk you through a few of them. So let's dive in. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. If you're new here, welcome. I'm Michael. Thank you for being here. I appreciate you guys' support being on the channel. And if you're interested in getting help moving to another country, getting residence permits there, it's one of the main things we do. The other kind of main thing that we do is we help you do international tax planning. So forming offshore companies, opening bank accounts, figuring out how to legally navigate the rules of whatever country you're living in or moving to, helping to guide you on what countries are best to move to for your particular situation, where should you set up a company, all that kind of stuff. If those things are helpful to you, please reach out to us. You can book a call with me, calendly.com/Michael-Rosmer, link in the description below, or send a message through offshorecitizen.net. Okay, great. So in Canada, what is the big deal? So if you move to Canada, you are going to be taxable on your worldwide income. So depending on where you're coming from, that might or might not be new. Importantly, your foreign companies could likely be taxable in Canada if you're going to control them from Canada. So you may have to do some restructuring in that regard. Third, even if you don't control them from Canada, they may be subject to something called Controlled Foreign Affiliate Rules. That's Canada's version of Controlled Foreign Company, or CFC rules. They have something called the FAPI, the Foreign Accrual Property Income rules. And so this is basically passive income that is held in foreign legal structures, tends to get taxed in Canada to the extent that it is owned by Canadian shareholders over a certain amount. So those are kind of like some high-level things that are important for you. And so you might be like, oh shit, my foreign company now may be taxable in Canada because I'm moving here. Or, oh, this asset that I own abroad may be subject to Canadian tax rules. Now, there's typically tax credits, and Canada actually has a pretty good network of tax treaties. Unlike some place like the US, they've got, I think it's 92 tax treaties in Canada. So fairly decent coverage in that regard. And actually, Canada has some fairly decent international tax planning rules as well. So to the extent that you have a foreign active business, you can often set that up so that usually you shouldn't have Canadian tax on that foreign company. Again, you may have to hire some people. There may be some nuances around that. If you need help with that, we can connect you with international fiduciaries, directors, things like this, who can help out with that process. But bottom line is that you can, in theory, make it so that the foreign company, or the foreign income may not be taxed, at least not taxed in Canada, it might be taxed where it is. That's a different conversation. We have to analyze that. And then you can actually pay dividends if you put it into a Canadian holding company, and the Canadian holding company can receive it tax-free. That goes into something called the general rate income pool. You'll learn about that later. And what that means is that if you pay out dividends, you can get something called the full dividend gross up. And so that can kind of, you can effectively have a net tax savings of somewhere around 20 to 25%, I would say. Call it around 20%. Just it depends on what province you're in, and there's some nuances about that. But let's say you can potentially save around 20% versus if you were to just kind of earn it directly in Canada. So that's pretty cool, right? That's a meaningful savings. If you're making $1 million a year, 200 grand a year is something. If you're making $5 million, $1 million a year is definitely something. So that's kind of the first thing to be aware of is if you're moving, number one, we may want you to restructure to put those assets into a Canadian holding company. That might be helpful for you. Number two, you almost certainly, if you have a foreign legal entity, will need to have some sort of foreign management and control, nuances about how exactly that works. The third thing that could be helpful for you is, I'll give you a little bit of history on. So they used to have something called Canadian pre-immigration trusts, okay? And so the idea was that you could put these assets into a trust and not be taxed on, that trust not be taxable in Canada for 5 years after you came in. Very nice system. They got rid of that quite a few years ago. And so you can no longer do that. However, there's something very interesting that you can potentially take advantage of. Not true for everybody, right? This is, your situation has to be proper, but I think there's like some interesting mindsets around what you can, the tools that you can utilize in order to optimize your tax situation, okay? And this is, Canada has really, really tough international trust rules to avoid. So if you are sitting in Canada and you set up a trust, the trust is basically going to be taxed in Canada. And the reason is they have something called Canadian resident contributor rules, okay? So what does that mean? That means if you are effectively a settler of the trust, so you're contributing to the trust, and you are a Canadian resident, it doesn't matter, importantly, whether you were a Canadian resident at the time that you contributed, okay? So you say, oh, great, like 10 years ago, I set up a trust for my kids or whatever, then I moved to Canada. Now that trust becomes taxable in Canada because I put these assets in there, okay? Again, tax treaties, there's lots of nuances, but that's pretty crazy, all right? So there's kind of a couple different ways that Canadian or trusts can be taxed from a Canadian standpoint. One is management control rules. There's kind of some more recent court rulings on that. But another is these Canadian resident contributor rules. And by the way, this is a fairly common way. I've done some videos in the past on how international trusts are taxed. So for example, if you're in New Zealand, they tax based on settlers. If you're in Brazil, they tax based on settlers. There's like a bunch of cases where they tax based on settlers. In some cases, they tax based on beneficiaries or trustees, or there's different ways. But Canada specifically is like really big on this settlers thing. Okay, cool. So what that means is that you can't just put your assets into trust, move to Canada, and not have them be taxed, or not avoid some of these other rules. However, there's a very interesting thing, which is as a Canadian resident, you can get unlimited gifts tax-free. Okay, unlimited gifts, including gifts from a trust. So if, for example, you had a foreign relative, right? So your parent, let's just say you're, moving from China or something, right? And your parents were to gift you money once you're a resident of Canada, you can get those gifts tax-free, no problem. If your parents then put the money into a trust and the trust gifts you, it's basically the equivalent of if the parent had just gifted to you directly. It makes perfect sense, right? Like that's, functionally what is happening here. It's just deferred, right? The one caveat there is that in the case of receiving a gift from a trust, they have trust capital and trust income. So income earned in that year will actually be taxable to you, whereas if it's accumulated capital from previous years, then it's not taxable to you. So anyway, sort of a nuance, but important nuance. So this opens up like a really interesting thing, right? Which is potentially, if you wanted to move to Canada and really, really optimize your tax, what could happen for you is that you could have somebody else set up a trust and contribute to that trust. And then that trust could end up gifting to you into the future. And you could receive that in Canada tax-free, like pretty crazy. Now, obviously, to the extent that the trust has local Canadian income, it's going to be taxable. To the extent that you're in a situation where it's managed and controlled from Canada, it's going to be taxable. But you could have foreign management control on a foreign trust that makes foreign money, and that trust could gift you, and you could literally pay no Canadian tax on that, and potentially the assets inside the trust could potentially have no tax on it, which is a pretty amazing situation. So that's probably like the main things that I would say you should consider when you're moving to Canada. There's lots of like local tax planning things, but there's a kind of, the stuff that accountants will do that kind of only carry you so far. These things of having a foreign company, which is in a Canadian company, being able to earn the income through there and being able to meaningfully improve it, that's the first thing. But you need to be aware of these other factors. And then this trusts thing is also like super fascinating. So I hope that helps. If you have questions about it, put them in comments below, reach out to us, book a call, and I will look forward to seeing you on the next video.